Hello, I'm Kamal Santamaria. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, the price of oil. It's falling and falling and falling, and OPEC, the great oil cartel, doesn't seem to want to do anything about it. We find out why OPEC isn't cutting production and if it's actually speaking with a united voice. And if that's not enough of a problem, then there's Iranian oil as well. Iran has the world's fourth largest reserves of crude, and with international sanctions about to be lifted, what kind of further pressure could that have on the price? Not a great time for other commodity producers either. We'll tell you about one global mining company that is slashing 85,000 jobs. We have talked about the price of oil for some time now because it's one of those things which has a massive domino effect. From entire economies to what you pay at the pump for petrol, oil is the massive contributing factor. Which is why it's quite odd that OPEC, the Organization of Petroleum Exporting Countries, isn't taking any steps to arrest the huge slide in the price of oil. At its latest meeting in Vienna, oil production was kept unchanged at 31.5 million barrels per day. Now, yes, OPEC has an obligation to keep the market well supplied, but why keep supplying an already oversupplied market? Maybe OPEC's just not as dominant as it once was. Since its foundation in the 1960s, the oil cartel has been the first place we've looked for the word on setting global oil prices. But the International Energy Agency says global oil production has averaged 97 million barrels per day in late 2015, and OPEC's output only accounted for a third of that. So to a certain extent, the cartel is seeing control slipping away at exactly the time that domestic financial pressures are growing. So how bad is the problem? Well, let's look at some numbers for you. The price of oil currently around $40 a barrel, but Brent crude dipped below that immediately after the Vienna meeting. At that level, it is less than a third of its value 7 years ago. So the OPEC members are feeling the pinch because really nothing less than around $54 a barrel is what's needed to balance the budgets. But let's think about some nations. Saudi Arabia and Qatar, plenty of cash reserves there to withstand the low oil prices. Saudi is OPEC's largest oil producer, around 267 billion barrels of the stuff, which is 18% of the world's proven reserves. But think about, let's say, Libya, Algeria, Venezuela, countries that are already in financial crisis. In fact, Venezuela, 95% of its income comes from oil. It is already in recession, and the economy is expected to shrink 10% this year. So this is where we get this internal struggle happening. Venezuela, for example, would want OPEC to change its policy, cut the oil production, and force the price of oil back up again, get some money back into their pockets. But the influential OPEC players, the Saudi Arabias, for example, want to keep production high because they don't want to lose customers to non-OPEC producers like the United States. Does it all make sense? Well, Barnaby Phillips was in Vienna for the OPEC meeting. Here is his report explaining more about the politics behind the decision not to cut oil production.
Low oil prices are hurting all 13 OPEC countries. Saudi Arabia, the biggest producer, has argued they're a necessary evil to help put rival non-OPEC oil producers in countries like the USA and Brazil out of business. But the weaker OPEC economies like Venezuela went into this meeting arguing that Saudi Arabia should cut production to force prices back up. Venezuela's oil minister told me his country was not alone in its financial difficulties.
Some people try to believe that we are desperate for a restoring the price, and only Venezuela is interested. That is a big mistake.
But you are desperate, aren't you?
All the countries that are producing are very worried about the price. All the countries, including the Saudis or whatever countries. Okay? So it's not only Venezuela, the one that is worried about it.
But after 7 hours of talks, OPEC announced there would be no cuts in production. It agreed only to monitor events in the months ahead. I asked the Nigerian oil minister how much pain continued low oil prices are going to cause his country.
The way we look at this is how do we utilize the opportunity of the pain, as you may quote and unquote, caused by a reduced price regime to try and get efficiencies in the system, efficiencies in production, efficiencies in cost management, efficiencies in transparency and everything. So, and efficiency in diversification of our local economy, because this is something that ought to have been done a long time ago.
So OPEC members have their disagreements on how to achieve a higher and more stable oil price. But the fact is, OPEC is not as powerful as it once was. Most oil is produced by other countries. And so OPEC's ability to fix the global oil price is limited.
Yeah, it is limited, but surely it can't defy conventional logic for too long either. Let's ask Kim Zietlow. He's an economist at Humboldt University in Berlin who's recently written about OPEC's dominance, or perhaps lack thereof. Kim, I really do want to go back to basics on this first of all. The prevailing or logical theory is that OPEC cuts production and then prices should go up, right? That is the simple idea, and that's good for OPEC countries, and yet they don't cut production. Can you walk us through that?
One solution to shift the price up again would be to get rid of this excess supply. And for OPEC, as one main actor in the market, one option would be to cut supply. But OPEC used to be a powerful actor when they acted as a cartel. But the recent developments, and especially what we could see last Friday, shows a different picture. And that's why production cuts by OPEC are quite unlikely to have an impact on the price in the end. First of all, it rather seems unlikely that OPEC can actually agree on production cuts.
Okay, so it sounds like what you're describing, Kim, is a group which we nearly always refer to as a cartel, but it's more splintered now, and that obviously will take away a lot of its strength and its efficacy.
OPEC was founded as a group with coherent interests, and they used to act in one way. They acted with a unanimous voice, but the situation today is that so many other factors play a role, and one factor, for instance, are geopolitical interests. And in that sense, we have to talk about the role of Saudi Arabia and Iran, for instance.
Okay, however, and I will come back to that in a moment, the flip side is that there is so much focus on these OPEC meetings, and then when there wasn't a production cut, the price of Brent crude went below $40 a barrel. So even if not directly, we are talking about OPEC still having a major bearing on prices.
Yeah, indirectly, yes. OPEC is still a main actor, and the world watches closely what is going to happen within OPEC and what message OPEC sends out to the markets and to all players worldwide. But usually the message from OPEC was a clear message. And what we could see last Friday was rather a split voice. And the reaction of the individual member countries was quite diverse. And that is new, and that is quite troublesome from the perspective of OPEC for the future.
Okay, so let's talk about some of those members, because you've mentioned Russia and Iran, obviously, but Venezuela, I feel, is a key player and example here. How bad have things gotten there in Venezuela for them to almost want to break away and lead this?
Yeah, Venezuela is a special case. Their fiscal budget, their national budget, heavily depends on oil exports. And that is why we could witness individual moves, individual efforts by Venezuela to cut production, and even on top of that, not just to find an agreement within OPEC. And we know that they pushed for it quite heavily last Friday in the meeting. But even before the meeting, talking to other players outside of OPEC.
Kim, I know it is fraught and even dangerous sometimes to try to predict the future and to crystal ball gaze, but I'm going back around 2 years here, and I was talking to people in the aviation industry, and they were saying, look, we've just got to get used to this. Our profits are going to take a hit because the price of oil is above $100 a barrel, and it's going to probably stay there. We all seem so sure of it, and now the situation has completely changed. How long do you feel we might be in this dip? I mean, I'm even seeing some talk about $20 a barrel.
Yeah, you're absolutely right. It's really dangerous to predict the future, especially in such a volatile market. There are solutions to shift the oil price to more sustainable levels up, but they are rather unlikely, and they are partially not in the hands of OPEC. So it's really difficult to forecast any certain price that would be reached in the future, maybe in half a year, maybe in 1 year. But it's even difficult to predict a price range.
But the thing is, though, it's not like the OPEC companies, or countries, I should say, will like this situation. Low prices, however long they last, they won't like them because it obviously affects their revenues. And yet they're not taking what would be a proven traditional step to inflate the price and bring the profits back. Now, you've talked about Venezuela taking its own track. What about other countries who would want to see more profits but aren't cutting production? I mean, would they go off on their own and do something? What do you think?
Yes. Absolutely. It's a really tricky situation, and also it's a really complex situation. If we consider all the different factors that play a role, economic interest, geopolitical interest, but also the role or the nature of the individual actors in the market. For instance, we cannot just take Russia or the United States as individual main actors, such as OPEC countries, because within Russia and also within the US, there is not just one big oil producer that is state-run. In those countries, the oil producers are privatized, so they are more or less liable to their stakeholders. And in that sense, they do not follow international political rules or political agreements, for instance, what OPEC countries could come up with.
Kim Zietlow, great to get your views on this topic. Thank you for joining us on Counting the Cost. And still ahead on Counting the Cost, job losses, a lot of job losses. The international mining company that's cutting 85,000 staff, and once again, it's because of a plunge in commodity prices. For now, though, we're going to continue with oil, and while we've already got this double whammy of weaker demand and higher production levels, things are theoretically about to get a whole lot worse. That is because Iran is about to re-enter the picture. With the world's fourth largest reserves of crude oil and second largest reserves of natural gas, it was pumping 4.5 million barrels of oil a day 10 years ago. But international sanctions brought that right down to 2.8 million barrels. When those sanctions are lifted, however, that could rise by 1 million barrels a day, depending on whether international companies decide to return and invest there. But if that whole theory we explained at the start of the show pans out, more oil on the market will mean continued lower oil prices. We've got an Iran expert with us this week to try to figure out how Iran's return to the oil market might play out. Azadeh Mascarian is a solicitor with the Iran department at Zawala & Co. in London. Azadeh, if we look at Iran through the prism of what happened at the OPEC meeting last week, where they didn't cut production. Now, there is a lot of oil around, and then there's potentially all this Iranian oil, which we've known about for a long time, I must say. That can come onto the market. The effect on the market and on the oil price, you would think, would be pretty big.
Hi, yes, certainly. I think, with the imposition of white blanket sanctions on the Iranian financial sector, as well as the oil and gas sector, the economy has crippled. And as you would know, Iran is adamant to move back into the market and regain its previous share. From what we've heard from the Iranian officials so far, it looks like shortly after the implementation day and lifting of the sanctions, we are looking at a significant increase of at least 1 million barrels per day on the Iranian oil output into the market, and Iran seems to be adamant to go ahead with it despite the reduction of the oil price.
Well, this is exactly what I was going to point out. They, the Iranians I mean, must know that this is going to happen, and they obviously want to get their oil working for them and their oil revenues working for them as much as possible. But you can't really do that when you're looking at maybe only $30, $40 a barrel of oil.
Well, I guess everybody will have to wait and see how things will turn out as far as the oil price is concerned. Is a little, I think it's a little too early to start and predict exactly and come up with figures such as $30 per barrel at the moment. You would know members of OPEC have significantly taken advantage of Iran's lack of presence and inability to market its share in the past few years. We've had some countries increasing their output, but by 10 million barrels per day in the past year alone. And I think everybody will have to take that into account and cut back their output and make room for Iran to regain its share in the market. I think Iran is in a great need of technology and foreign investment in its oil sector. And you would know with the introduction of the IPC contracts early in November, and for that to be followed in February in London, we are looking at attracting around $30 billion of foreign investment in oil and gas sector alone. And being one of the largest holders of oil and gas in the Middle East, Iran is adamant to go ahead with it.
So would you say then that you're confident Iran will actually be able to bring in that foreign investment? Because, I mean, well, I assume they'll be interested in coming into a new market, and there'll be a lot of countries and companies which are positioning themselves to do that. Are you confident, though, that that will actually happen?
Well, I think it will take a little more time. Although the sanctions are due to come off as of the first quarter of 2016, we'll have to be a little more patient. Of course, not all sanctions are coming off. Everything relating to the oil and gas sector, as far as the EU sanctions are concerned, will be lifted in one go as of implementation day. Be that as it may, there is a risk of snapback provisions, and I think some entities may be very cautious to move back into the Iranian market. Apart from that, we've got the cutoff of banking channels on Iran because of the blanket financial sanctions imposed on Iran. And let all remember that the removal of sanctions does not mean an immediate return of international banks into Iran. And without the implementation of sufficient banking channels into place, not all entities may be willing to enter the market because you won't be able to get paid. So I think it's going to go hand in hand, and it may take a little more time. But from what we're hearing in the media and the Iranian officials, it looks like Iran will be increasing its output significantly within a week of the lifting of sanctions and implementation day.
What more do you think, though, that Iran could do to help itself here? How the sanctions are lifted, and I mean, that'll be up to other countries how they actually implement that. But what could Iran do for itself to make it more attractive to those investors to come in and buy that oil and infrastructure and these things?
I think a lot of publications have been done. If the Iranian side of the deal has been doing everything that's necessary under the terms of the JCPOA to reflect its willingness to honor the agreement, we are going to have to hopefully see the same from the European and the US side of the deal. And Iran has also been opening up the market. There are domestic legislation being passed through the parliament in Iran to make it a safer and a more transparent environment for foreign businesses to invest in Iran. The new IPC contracts introduced by the Iranian government are offering a much more attractive package to international oil companies and the medium-sized and the large-sized ones, and offering them opportunities to invest for a period of 15 to 20 years and to invest in exploration, production and development of the fields. So I think what we're looking at is a very attractive field of opportunity for large and medium-sized oil and gas companies to move back into Iran.
Azadeh Miskarian, a pleasure talking to you. Thank you for joining us this week.
Thank you for having me.
Now, with so much focus on the falling price of oil, we got a nasty reminder this past week that other commodities are in dangerous territory as well. The mining giant Anglo-American is cutting 85,000 jobs worldwide, 2/3 of its workforce, because it's been hit by the falling commodity prices. And not just that, its share price dropped as well, almost 70% this year as well. In a moment, Famida Miller brings us a report from South Africa, where Anglo American employs 72,000 people in its mines. But first, Charlie Angela on the big cutbacks.
With mining operations on 6 continents, news that Anglo American is in crisis will be felt worldwide. Falling prices for iron ore and other commodities have already hit all mining companies hard. Now the world's 5th largest mining company is taking action with some radical restructuring. Anglo American is cutting 85,000 jobs. That's 2/3 of its entire workforce. The company will also suspend dividend payments for the rest of this year and into 2016. To balance the books, it will sell off assets, almost half of its 50 mines, and merge its 6 businesses into 3. That will be De Beers, the diamond producer, industrial metals, and bulk commodities like iron ore. The crisis is fueled in part by falling demand from China. On Monday, the price of iron ore hit a 7-year low, dropping below $40 a tonne. That's close to break-even point for many major miners. Platinum too is close to a 7-year low. Even diamonds have had a disappointing year. The company hoped that by diversifying it could weather a financial downturn. They spread their earnings across a number of commodities, but nearly all of these have dropped in price at the same time. The question now is, will these measures be enough?
The company believes at the current commodity price environment, they have right-sized the business for growth going forward. However, if commodities were to decline as a whole by another 20-25%, it probably means that they haven't done enough. And that is the risk at this moment in time that is obviously being reflected in the share price declines today.
Anglo American's chief executive had this to say: "The best answer for our shareholders is to go down to a smaller, more resilient portfolio. That's where we're going, and we're not going back." Well, this is the company's headquarters, and inside the mood must be pretty sombre. Anglo American has seen its share price fall by 70% this year, and the reorganisation to remedy that is going to be brutal. When they're done, they're going to be left with a very different company.
Mining companies have suffered a big drop in profits because of plunging commodity prices around the world. More than 23,000 jobs have already been lost in South Africa's mining sector this year alone. Plans by Anglo American to make 85,000 workers redundant worldwide does not bode well for an industry already under strain. Anglo American employs 72,000 people in South Africa, but won't tell them what's happening until the new year.
As the NEM, we were caught by surprise. And so we just feel that what the most important thing that we want to see is for the company to save jobs, not to shed jobs anymore. Because as we speak right now, the unemployment rate in South Africa is sitting at 25%.
Some are predicting that in the short term, up to 3,500 local mining jobs are at risk in the iron ore, platinum and coal mining sectors.
I expect next year's mining industry to be even in a more critical condition, and with that comes the pressure of how labor is going to respond, how investors are going to respond, how policymakers are going to respond. So if we thought 2015 mining South Africa was hard, I do think 2016 mining South Africa is going to be impossible.
Metal prices are showing no sign of recovery from their lowest level in 6 years. As Anglo American reviews its unprofitable operations, there are concerns that the local mining industry will only suffer further.
And just a footnote on South Africa, they're also having to deal with the fallout from a political scandal there after President Jacob Zuma fired the country's finance minister. Nhlanhla Nene is well regarded by business people and investors. And it's even more bizarre then that Mr. Zuma gave no reason for throwing him out. Nene's departure spooked the stock market. South Africa's currency, the rand, also had its biggest drop in value in 4 years. And only a week ago, the credit ratings agency Fitch downgraded South Africa to just one step above junk status. All in all, not a great end to the year for South Africa. Remember, it was overtaken by Nigeria recently as Africa's biggest economy. We'll leave it there for this week, but there's more for you online at aljazeera.com/CTC. That takes you straight to our page with individual reports, links and entire episodes for you to catch up on. You can also get in touch with us. You can tweet me at KamalAJE and do use the hashtag AJCTC when you do, or just drop us an email. Counting the Cost at aljazeera.net is the address. So that is it for this edition of Counting the Cost. I'm Kamal Santamaria from the whole team. Thanks for joining us. The news on Al Jazeera is next.